Something is happening beneath the surface of global markets that most people will only understand when it is already too late. Silver is not just moving, silver is behaving differently. The rules that governed this market for decades are being rewritten right now. And the question every serious investor, every business mind, every entrepreneur should be asking is not, should I buy silver? The real question is, do I even understand the market I think I know? Because what is coming next has nothing to do with charts or candles or headlines. It goes much, much deeper than that. Long pause. Stay with us. You will want to see this. Welcome to Financial Crisis. Explained, the channel where we do not guess, we do not panic, and we certainly do not follow the crowd. We analyze, we decode, and we hand you the kind of clarity that turns confusion into confidence. Now, before we go any further, and we say this with the greatest respect, if you have not yet subscribed to this channel, think of it like this. You would not sit down for the most important meal of your life, pull up a chair, taste the first bite, and then get up and leave before the main course arrives. That would be a tragedy. So do what a wise person does. Hit that subscribe button right now, before this moment passes, because every video we make is a full course meal. And today's serving is one you cannot afford to miss. And one more thing, we genuinely want to know, where in the world are you watching this from? Drop your city, your country, your corner of this earth, right there in the comments below, because this crisis, this shift in silver, does not care where you live, but we do. Now, let us begin. There is a particular kind of silence that precedes an earthquake. Not the silence of peace, not the silence of stability, but the silence of pressure. Enormous, invisible, accumulating pressure, building beneath the surface until the ground itself can no longer hold its shape. That is the silence serious market observers are hearing right now in silver. Not chaos, not collapse. Something far more consequential than either. A structural shift. For the better part of 2 years, silver has behaved in ways that conventional analysis struggles to explain. It rises sharply, then retreats with equal violence. It defies the models, it ignores the headlines, and just when the broader market concludes that silver is simply volatile, that it is doing what silver has always done, it moves again, differently, more deliberately, as though it is responding to a set of instructions that most market participants have not yet received. This is not random behavior. Random behavior has no pattern. What silver is exhibiting right now has a very distinct pattern. And that pattern, when examined carefully, tells a story that goes far beyond price action, far beyond supply and demand, and far beyond anything a standard financial report will reveal. To understand that story, one must first understand what silver actually is. Most people think of silver as a precious metal, a commodity, something that sits in a vault, gets traded on an exchange, and fluctuates with the mood of the market. That understanding is not wrong, but it is dangerously incomplete. Silver is simultaneously a monetary metal, an industrial input, a strategic resource, and a global financial instrument. It exists at the intersection of multiple economic worlds at once. And that intersection, that precise point where monetary policy meets industrial demand meets geopolitical strategy, is exactly where the current disruption is taking place. The global uncertainty gauge, a composite measure of cross-market stress that institutional analysts track closely, has been sitting near record territory, not briefly, not as a spike, but as a sustained condition, a new baseline of instability that is quietly reshaping how every major financial instrument behaves, silver included. When uncertainty sustains at this level, capital moves, not randomly, strategically. It seeks assets that hold value outside the traditional financial architecture. And silver, for reasons both historical and structural, becomes one of those destinations. But here is where the story deepens. Capital moving into silver is not new. It has happened before, in 2008, in 2011, in 2020. Each time the mechanics were relatively straightforward. Fear entered the market. Investors sought safe havens. Silver prices moved. The storm passed. The market normalized. What is happening now is categorically different. This time, the rules governing how silver is traded, held, and delivered are themselves changing. Not gradually, not through slow regulatory evolution, but through a series of targeted enforcement actions, new position limits, account restrictions, and policy shifts, emanating from both the East and the West, that are fundamentally altering the plumbing of this market. And when the plumbing of a market changes, everything built on top of that plumbing changes with it. Consider what the average entrepreneur or business decision maker understands about silver. They know the price. They may know it is used in electronics and solar panels and medical equipment. They may even know it has historically moved in relation to gold. But what they almost certainly do not know what almost no mainstream financial commentary is discussing with the seriousness it deserves, is that the framework through which silver trades globally is currently being renegotiated. Not negotiated, renegotiated. That distinction matters enormously. It means an existing system, one that has functioned, however imperfectly, for decades, is being dismantled and reconstructed while trading continues, while positions are held, while contracts expire, while ordinary investors watch their screens and wonder why silver is not behaving the way it used to. It is not behaving the way it used to because the market it used to exist within is no longer the market it inhabits today. That is the tremor beneath the surface. And in the next part, we go east, because the most significant force currently reshaping silver's global architecture is not coming from Wall Street. It never was. The Eastern engine rewriting. The rules. Most market disruptions have a villain, a reckless bank, a failed hedge fund, a policy mistake made in a marble building somewhere in Washington or Brussels. Western financial media has spent decades training its audience to look for the source of instability in familiar places. Familiar institutions, familiar failures, familiar faces. This time, the source is not familiar. This time, the story begins in Shanghai. There's a number that very few people outside of institutional trading circles pay close attention to. It is the spread, the difference between the silver price on the Shanghai Futures Exchange and the silver price on the COMEX in New York. For most of modern financial history, that spread has been relatively contained, modest, manageable, the kind of number that analysts note but do not lose sleep over. In recent months, that spread has stopped being modest. China's silver price has been running measurably, consistently, and at times dramatically hotter than its American counterpart. And that single data point, quiet, persistent divergence between East and West, is one of the most important signals in global commodities markets right now. The question serious analysts must ask is not simply, why is China's price higher? The deeper question is, what does China know that the rest of the market is still processing? To answer that, one must understand how China's relationship with silver has evolved. Not over months, but over years. China is simultaneously the world's largest silver consumer and one of its most active trading participants. Its industrial appetite for silver is not theoretical, it is structural, embedded into the architecture of its manufacturing economy in ways that cannot be unwound quickly or cheaply. Solar panels, electronics, electric vehicles, semiconductors. Every pillar of China's industrial ambition rests, in part, on silver. And as that ambition has accelerated, so too has China's desire to exert greater control over how silver is priced, allocated, and delivered within its own borders. What the world is now witnessing is the consequence of that desire becoming policy. In recent months, Chinese regulators have moved with unusual speed and specificity. Enforcement actions have been executed against trading accounts operating outside newly defined parameters. Position limits near delivery, the critical moment when paper contracts must be settled with physical metal, have been tightened with a precision that left many market participants scrambling to adjust. These were not routine administrative updates. Routine updates are announced with advance notice. They come with transition periods. They are designed to minimize disruption. What happened in China's silver market was different. It was swift. It was targeted. And it sent a message that the most sophisticated observers understood immediately, even if the broader market took longer to catch up. China is not simply regulating its silver market. China is reorganizing it. And then came the phrase that stopped institutional trading desks mid-conversation: zero allocation. 2 words, enormous implications. And almost immediately, a media ecosystem that did not fully understand their meaning began filling the silence with speculation. Zero allocation sounds, on its surface, like scarcity, like shortage, like the physical metal has somehow disappeared from the system. And that interpretation, emotionally compelling, narratively satisfying, financially terrifying, spread faster than any correction could follow. But here's what zero allocation actually means in the context of Chinese regulatory mechanics. It means that certain categories of market participants, specifically those whose positions were flagged as non-compliant with new delivery proximity rules, were allocated zero entitlement to physical settlement, not because the silver did not exist, but because the rules governing who could claim it, when they could claim it, and under what conditions, had changed. The silver was there. The access to it had been restructured. That is not a shortage story. That is a control story. And control is precisely what this entire chapter of silver's history is about. China is not reacting to market conditions. China is engineering them. By tightening who holds positions near delivery, by allowing its domestic price to run above global benchmarks, by selectively enforcing rules that redirect physical metal flows, Beijing is quietly constructing a silver pricing architecture that serves Chinese strategic interest first and global market equilibrium second. This is not speculation. This is observable in the data. And it raises a question that every entrepreneur, every business strategist, every serious decision maker must sit with in silence for a moment before moving forward. If the world's largest consumer of silver is simultaneously rewriting the rules of how silver is owned, priced, and delivered within its own borders, what happens to the rest of the world's assumptions? What happens to the contracts, the ETFs, the institutional positions built on a framework that assumed the old rules would hold? What happens to the price? That answer begins to take shape in the West. Because while China has been reorganizing its silver market from the inside, America has been watching, and America has quietly begun to respond in ways that almost nobody is talking about. The vault idea and the Western recalculation. There's an old principle in geopolitical strategy that rarely makes headlines, but almost always makes history. When one power reorganizes its infrastructure quietly, the other power reorganizes loudly enough to be reassuring, but not loud enough to reveal how concerned it actually is. Watch what America is doing with silver right now, not what it is saying, what it is doing. For decades, the United States has operated from a position of profound institutional confidence in its silver market infrastructure. The COMEX, the Commodity Exchange of New York, has functioned as the undisputed global benchmark for silver pricing. Its contracts, its settlement mechanisms, its warehousing systems have been treated not merely as functional by a tribunal, but as authoritative, as the standard against which every other silver market in the world measured itself. To understand why the vault idea matters, one must first understand what it is actually proposing, and more importantly, what its emergence reveals about the current state of American confidence in existing silver infrastructure. The proposal, in its various forms, centers on the creation of domestic silver vaulting capacity that operates with greater transparency, greater regulatory oversight, and greater physical accountability than the current system provides. On the surface, it sounds like an administrative improvement, a logistical upgrade, the kind of bureaucratic refinement that generates minimal public interest and maximum institutional applause. But read between the lines of that proposal, and a very different story emerges, because institutions do not redesign their vaulting infrastructure when they are confident in it. They redesign it when they are not. The question that must be asked, with precision, without sentiment, is this: why now? Why, at this precise moment in silver's history, is America revisiting the physical infrastructure through which its silver market operates? Why, when China is simultaneously restricting delivery access and running domestic prices above global benchmarks, is the conversation about American vault capacity suddenly urgent? The answer, when examined honestly, points in one direction. The existing framework, the one that has governed American silver trading for decades, was built on a set of assumptions about how global commodity markets function. Assumptions about price discovery, about delivery reliability, about the neutrality of market participants, about the stability of the rules governing cross-border metal flows. Those assumptions are no longer holding. And when foundational assumptions fail, the infrastructure built upon them requires reconstruction. Now consider what this means for the different categories of market participants, because the implications are not uniform. They are deeply, consequentially unequal. For institutional investors, the pension funds, the commodity trading houses, the macro hedge funds that hold silver positions as part of diversified portfolios, the vault reconfiguration signals something they are trained to interpret immediately. It signals that the cost and complexity of physical delivery is about to change, that the ease with which paper silver positions can be converted into physical metal may be entering a period of structural friction, and that the premium attached to verifiable, domestically vaulted, physically allocated silver is likely to rise. For ETF holders, the millions of retail and semi-institutional investors who hold silver through exchange-traded products, the signal is more nuanced but no less significant. ETFs operate on the assumption that the physical metal backing their shares is accessible, auditable, and deliverable. If the vaulting architecture underpinning that assumption is being redesigned, then the relationship between paper silver and physical silver is entering a period of recalibration. And recalibration in commodity markets rarely happens without price consequences. For physical silver holders, individuals and institutions that have taken direct possession of the metal, the emerging landscape looks, relatively speaking, more favorable than it has in years. Not because the price is moving in any particular direction, but because the premium attached to physical possession, to actual verifiable allocated metal held outside the financial system's paper architecture, is being quietly repriced by the market itself. Scarcity of access is not the same as scarcity of supply, but in practice, the price does not always know the difference. And here is where the American response reveals its most uncomfortable dimension. Because there is a harder question lurking beneath the vault idea, one that institutional analysts are beginning to ask in private, even if they are not yet asking it publicly. Is this adaptation, or is this desperation? Is America redesigning its silver infrastructure because it has identified a genuine opportunity to modernize a system that has grown outdated? To build something more transparent, more resilient, more suited to the demands of a multipolar commodity world? Or is it redesigning because the existing system, the one that has served as the global benchmark for decades, is showing structural vulnerabilities that cannot be patched, only rebuilt? The distinction, it matters enormously. Adaptation is the response of a system that is evolving from a position of strength. Desperation is the response of a system that has recognized, perhaps later than it should have, that the ground beneath it has already shifted. The vault idea is real. The conversation is real. The urgency behind it is the most revealing thing of all, because urgency in financial infrastructure does not emerge from opportunity alone. It emerges from necessity. And necessity, in this context, has a very specific name. It is called China. It is called the Eastern reorganization of silver's global architecture. It is called the slow, deliberate, unmistakable process of a market that ran on old rules, waking up to the reality that the old rules no longer apply. The West is recalculating. The infrastructure is being redesigned, and somewhere between Shanghai and New York, between zero allocation and vault construction, between Eastern control and Western adaptation, the real story of silver is taking shape. It is not a story about price. It is not a story about charts. It is a story about architecture, about who controls the pipes through which silver flows, who sets the pressure, and who gets to decide when the valve opens. And in part 4, we pull back further than we have gone before, because what is happening to silver is not happening in isolation. It is happening inside something much larger, a rewiring so fundamental, so deliberate, so global in its scope that most people will not recognize it until it is already complete. When market plumbing changes, everything changes. There is a moment in every great structural transformation when the people living through it finally stop asking, what is happening to the market? And start asking a far more unsettling question. What kind of market are we moving into? That moment, for silver, is now. Step back from the charts. Step back from the enforcement actions, the vault proposals, the spread between Shanghai and New York. Step back from every individual data point that has been examined in this analysis, and look at the complete picture that those data points assembled together are painting. What emerges is not a story about silver having a difficult quarter. It is not a story about regulatory overreach in China or infrastructure anxiety in America. What emerges, when the lens is wide enough and the analysis honest enough, is the story of a global financial architecture in the process of fundamental reconstruction. And silver is not a victim of that reconstruction. Silver is one of its most precise and revealing indicators. To understand why, one must understand what silver has always represented at the deepest level of economic history. Gold carries the mythology. Gold attracts the headlines, the central bank announcements, the dramatic proclamations about monetary sovereignty and reserve currency dominance. But silver has always been the metal of commerce, of transaction, of the actual physical exchange of value between parties who do not fully trust the systems mediating their trade. When silver moves in the way it is moving now, not just in price, but in structure and access and the rules governing its flow, it is not sending a message about silver, it is sending a message about trust, specifically about the erosion of trust in the existing architecture of global trade settlement. Consider the 3 forces that have been examined in this analysis and place them side by side. China is restricting who can hold positions near physical delivery, concentrating control over the moment when paper promises must be converted into real metal. America is redesigning its domestic vaulting infrastructure, acknowledging implicitly that the existing system requires structural reinforcement. And beneath both of these national-level responses, the global uncertainty gauge continues to hold near record territory, signaling that the stress driving these changes is not temporary, not cyclical, but systemic. 3 separate actors, 3 separate responses, 1 unified signal. The global commodity settlement system, the invisible infrastructure through which raw materials are priced, traded, and physically transferred across borders, is being reorganized along new lines of national interest, strategic control, and geopolitical alignment. This is what economists and policy analysts mean when they speak, with increasing frequency and increasing seriousness, about de-dollarization. Not the dramatic, overnight collapse of dollar dominance that financial media occasionally sensationalizes, but the slow, structural, methodical process by which nations, particularly those with significant commodity resources or significant commodity appetite, begin building alternative mechanisms for pricing and settling trade outside the existing dollar-denominated framework. silver sits at the intersection of that process. Because silver is both a financial asset and a critical industrial input. Because it cannot be printed, cannot be digitally replicated, and cannot be conjured through monetary policy. Because when the trust in paper-based settlement mechanisms erodes, the metal that has historically anchored commercial exchange becomes strategically valuable in ways that go far beyond its market price. And this is where the analysis must speak directly to the entrepreneurs, the business strategists, the serious decision makers who have followed this story to its conclusion. Because the implications of what is being described here are not abstract, they are not theoretical, they are operational, meaning they will affect real businesses, real supply chains, real cost structures, and real strategic decisions in the months and years ahead. Consider what a reorganized silver market means for industries that depend on silver as an input. Solar energy manufacturers, electric vehicle producers, semiconductor fabricators, medical device companies. These are not peripheral industries. They are the industries around which the next generation of economic infrastructure is being built. And if the rules governing silver's allocation, pricing, and physical delivery are being restructured along geopolitical lines, then the cost and reliability of accessing silver as an industrial input is no longer purely a market question. It becomes a strategic question, a sovereignty question. The kind of question that governments and corporate boards are beginning to ask simultaneously, which is itself one of the most significant developments in global industrial policy in a generation. Now consider what this means for the price of silver itself. Not in the short term. Short-term price prediction is the domain of traders, not analysts, but structurally, directionally, over the horizon that serious strategic thinkers must be willing to look across. When a commodity simultaneously becomes more difficult to access through existing paper mechanisms, and more strategically valuable to governments and industries operating in an environment of geopolitical fragmentation, and more physically concentrated in the hands of entities that have made deliberate choices to hold it outside the traditional settlement system. The direction of structural price pressure is not difficult to identify. It is not guaranteed. Nothing in markets is guaranteed. But the architecture of the argument, the weight of the forces being described, points toward a silver market that will be simultaneously tighter, more fragmented, and more strategically consequential than anything the previous generation of investors or business leaders had to navigate. This is what it means when the plumbing changes. The water still flows, but it flows differently, through different pipes, under different pressure, controlled by different hands, subject to different rules about who receives it, when, and at what cost. The rewiring of silver's global market architecture is not a future event being predicted. It is a present reality being documented, and the single most dangerous position any entrepreneur, investor, or business strategist can occupy in this environment is the position of someone who is still reading a market that no longer exists, through a framework that was built for a world that is rapidly receding. The tremor has been felt, the Eastern engine has been identified, the Western recalculation has been examined, and now the full architecture of the shift stands visible, not as speculation, not as fear, but as a structured, documented, analytically grounded reality. Silver trading is shifting forever, not because of a single event, not because of a single policy, but because the world in which silver traded the old way is being replaced, deliberately, systematically, and irreversibly, by a world that has decided the old way is no longer sufficient. The only question that remains, the one that every serious mind watching this must now answer for themselves, is not how will silver price react? The deeper question, the one that determines whether you navigate this moment with clarity or get swept away by it, is simply this. When the rules of a market change forever, are you the one who sees it coming? Or the one who reads about it afterward?